In this chapter, we will talk basically about financial statements like balance sheet, income statement, and then the resultant cash flow statement. And cash is the king. You have heard this before. And then we will see how to generate free cash flow. You are responsible to generate free cash flow. So balance sheet, income statement, and a statement of cash flows, and then using free cash flow, EVA and MVA are two metrics by which you say that, well, how the company is performing. So balance sheet is basically a snapshot of firm's financial position. So this is as it is of December 31st, and then income statement is over a given period of time. So this is basically stock, and this is flow. And then you get cash flows and also a statement of shareholders' equity. And this is about the company Didion, and it's they expanded in 2017, and the results are unsatisfactory. Their cash position has weakened. Suppliers are being paid late, and they are threatened to cut off credit. Bank has threatened, that is, notes payable is being threatened, and board of directors has ordered that change must be made. So you are looking into it. So this balance sheet for 2017, this is 2017, and this is 2018, and this is when you look at this, the changes, you can see that, well, cash has decreased from 57,600 to 7,282. So this changes in cash, you'll figure out through the statement of cash flow. So when you know the change is the same as 57,600 minus 7,282, that means your cash flow statement is done right. Accounts receivables, inventories, all of them make total current asset, and then you have gross fixed asset minus depreciation, and which is net fixed asset. So net fixed asset is 939,790, and total asset is 2.866592. And then you have liabilities and equities, which is accounts payable, accruals, notes payable, and long-term debt, common stock, and this is known as retained earnings, which is a cumulative retained earnings. I mean, it is added or added every time as you earn net income. So net income is partitioned between retained earnings and dividends. Then after balance sheet, you look at the income statement, and then you can see that this part, this 6.047988 is known as EBITDA, because it is earnings before interest and taxes and depreciation. So there is no subtraction yet. So this is the core business earnings. So CEO, basically it is their favorite flow of income. So this is called upstream flow. EBIT is the basic earning power, is the midstream flow, and that income is the bottom stream flow. So out of these three flows, CEOs say that, well, we earned this much, and then when interest and depreciation, amortization are subtracted, then you say that, well, this is not what we earned. EBIT is not what we earned. It is the EBITDA that we earned. So usually company CEO and CFO, they basically present themselves before the investors, and that is what is stressed. And result of that is that you look at earnings per share and dividends per share and the result on stock price. So you can see that price was $8.50 in 2017, and 2018 it is $2.25. So company is being punished by the market for their performance. And then we move on to the statement of retained earnings, which is basically common stock plus retained earnings is shareholders' equity. So this is the cumulative retained earnings. And when you add these two, you can see this is the amount of retained earnings used when you do not have earnings. But this company has negative earnings, which is 160,176. So with that, we just say that whenever you are looking at balance sheet and income statement, you identify them as something that generates the inflow or generates the outflow. So to do that, you have to identify each one of them as operating item, investment item, or financing item. So you ask this question, two questions: Is this an asset or liability? And then if it is asset, has it increased or decreased? So let me take two items there from balance sheet. One is accounts receivable. You say this is when you ask the question, is this an asset? Then you say, yes, it is an asset. And then you say, has it increased or decreased? In this case, it has increased. So you say outflow. Increase in an asset is an outflow, and decrease in a liability is an outflow also. So increase in asset, so asset increase, and decrease in a liability, both of them is outflow. And then on the other hand, you pick another item from balance sheet, which is called accounts payable. So you say, is this a liability or asset? You say it's liability. Has it increased or decreased? If it increases, then it's an inflow. And in this case, you say, if asset declines and if liability increases, then you say both of them is going to generate an inflow. So what we do next is that if you see, we divide those items into operating item, investment item, and financing item. In operating item, this is the lifeblood of the company. If you do not generate positive cash flow from here, market will basically make your prices go down. So first thing you do is net income, and the second thing you add depreciation and amortization to that. So that is the primary cash flow. These two are the primary cash flow. And then you look at the accounts payable. You see that accounts payable has increased. Therefore, this is a liability. That means you have an inflow. And then this is increase in accruals also is a liability. It has increased, therefore it is an inflow. Increase accounts receivable is an asset. It has increased, therefore it's an outflow. And so in parenthesis is negative number, and inventories are asset. Increase meaning it has an outflow. So net result, net cash from operating activities are outflow of 164,176 is a very bad statement of cash flow for the company. So the market will basically discipline this company. And then you have investing activities is another section, and you can find out net cash used in investing activities. You see here a large negative number. This you never, basically you have to probe further. Is this investment a necessity, or is this basically a wastage? So depending on the answer, if it is a wastage, then this is a very bad number. But if it is for growth, then this is a good number. Financing is, you have to say how the financing takes place. Is it from short-term loans from the bank? So, or is it from long-term debt? And so in this case, we see the large numbers are coming from short-term as well as long-term. And then you include this at this level. We only have three activities that we sort things out: operating, investing, and financing. But in a higher level courses, you separate this into 12 different categories, and their dividends is treated in a different way. So here we treat dividends in here, right, in financing, and then we say net cash provided is 825, which is positive because something has to come from somewhere to finance your activities. So you see that you have cash at the beginning is 57.6, at the end is 72.82. The changes in cash, this 72 from 57,600 and say is resulted from that, and this is the net decrease in cash. This is changes in cash, and not this one. So changes in cash is this one, and that is exactly what you saw at the beginning. So when your statement gives you this number, you are assured that your statement of cash flow is done right. Then you conclude that net cash flow from operation is 164, 176, and then the firm borrowed 836, 808, and then even after borrowing, the account cash fell by 50,318. Not a good thing to look at. So then next thing is, after doing the statement of cash flows and then drawing your inference that this company is not doing at all, therefore its stock price will decline, you say that, well, let us now look at operating working capital, because operation is the lifeblood, as I mentioned before. So you know net working capital, which is current asset minus current liabilities. Net operating working capital is operating current assets and operating current liability. So we have net operating working capital, which is current assets minus excess cash. That means any cash related thing has to be subtracted, and current liabilities, notes payable, has to be subtracted. So the result is that you get only operating working capital. So that is what it is. Then we look at this is NOPAT, net operating profit after taxes, and this is EBIT times 1 minus tax. So that's your 18, and then it is 19. So 18 is this, and 19 is this one. So after that, you figure out net operating working capital for year 18, and so which is 905,760, and then you have for net operating working capital for 17. So with that, we collect those information on this slide, and then the last thing is to generate FCF. Then all these you can put it on a formula sheet, because on exam you need to have ready access to the formulas, and you have got the books and the notes and so forth, but the most important part is this, because you won't have time to figure out the formulas. So put this formula on the formula sheet, and when you put all those numbers in here, we get FCF for 18, which is a negative number. As you can see, it's a negative number, and then means that for FCF, if you have FCF of 0, you are still doing good. But if you have FCF greater than 0, you're okay, you're better. But when you have excess or surplus FCF, there will be a tendency to basically squander money. And so that is also not looked at very positively. So is negative cash flow always bad? Not necessarily, depending on what you do. Like if you're expanding in the right way, then negative cash flow, free cash flow can result. So then there are different ways to evaluate the managers. You have heard that, well, some CEOs are making 40 million a year or even more. So is market unwise to pay them such high amount? So there are two measurements. One is market value added, and which is basically take the price and the number of shares and the book value that is in the book. And you say that, well, market value has gone up, therefore the company is doing well. Economic value added is the true economic profit, and which is going to be this one, that is NOPAT minus the total investment capital and cost of capital. Cost of capital is a measurement by which it is the required rate of return by all the shareholders and bondholders. So this is the requirement. Cost of capital is the requirement, and this is the total invested capital or supplied cap, and then you subtract from NOPAT. If it is greater than 0, that means that CEO is doing well. I mean, they are generating more inflow than outflow. So for this company, your MVA 18 is 267,000, and then your MVA of 17 is 186. So you see then the market value added is destroyed in the sense, because this is a negative 267. So you can say that this company is not doing well, but that is not necessarily these are not necessarily the correct measurement, because when a boat rises in a swirling water, or it is not because the boat is rises by itself. It is by market. As market goes up, your stock market, your own stock prices can go up too. So that is why we said that, well, this is not necessarily a great metric. So we look at EVA, and if EVA is positive, that means it is greater than the cost of capital. Therefore, a company is doing well, and CEOs are paid hefty amount. And then you have what do you think, that they paying suppliers on time? Not necessarily. And then AP has increased, and then if this continues, suppliers may cut off deal on trade credit liens. Okay. Now you see, you try to generate a price should exceed or equal cost. But in this case, that is not the case. So they are going to have a negative income. So, and the whole reason we have gone through all of these, that is, AR increases, cash decreases, and all of short run and long run collections in the previous slide. So how did De Leon finance its expansion? Through external capital and also drawing down the retained earnings. So with that thing, we say the company would still have to finance its increase in assets. So looking at the statement of cash flow, and this is the number that you can see in net fixed assets. And so it has to raise additional capital. So with that said, we say that, well, De Leon case is not really a great one, and these are the results of their expansion activities, and we are not going to do the taxes, so the tax payments would decline if you do that. But for your case, we are leaving out the tax from chapter 3. Hope it is clear to you. If not, let me know. Thank you.